Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Saturday, March 22nd, 2025. Today's episode begins with CoreWeave IPO. You'll see news articles out there saying CoreWeave IPO is asking for too much money for its stock, and other articles saying not enough money. What do I have to say? Well, it's a great time to have an IPO if you're a company searching for money, because the entire stock market right now has a CAPE ratio of 35. This is historically high. This is nosebleed expensive, dangerously high prices in stocks generally. So IPOs in these situations attract a lot of capital, a lot more than a conservative valuation would tell you. I don't even need to look at the numbers of CoreWeave to tell you that they're asking for way too much money. And the PE of this regular PE of the S&P 500 also extremely elevated at 28 right now. Additionally, the S&P 500 dividend yield, by the way, all these charts go back about 150 years. We've never seen a lower return as far as yield goes from stocks, except for briefly in 2000, where we dropped to a low of 1.11%. We're at 1.32%. Stocks have basically never been more expensive, so IPOs are generally very dangerous. The only time I have participated in IPOs before, namely the DJT one, I saw that from a mile away that it was going to get a lot of dumb people on board like very quickly. I bought options contracts on the open, call contracts, sold them the next day at a huge gain. I don't do that often, but yeah, there's no safety here. So yeah, I'm not going to be participating in it. If you do, good luck to you. I hope you find someone to purchase the stocks that you bought for a higher price than what you paid for them. Sounds like a Ponzi scheme, smells like a Ponzi scheme, looks like a Ponzi scheme. Anyway, next item on our agenda, the S&P 500 still looking bearish. The S&P 500 SPX needed to find a bit of a middle ground. Friday was a triple witching day. This is when institutions need to make sure that all their options contracts that they sold go to zero so they can make as much money as possible off of those options. So we are stuck in limbo in this area. That's very expected on a day like that, and we're still very much within this bear flag pattern, very clear. Add to this that the advanced decline line actually had a significant drop while the S&P 500 actually went up by 0.08%. This says that the price of the S&P 500 went up not because the stock market really went up, but the bigger cap names got more of a bid, and the smaller cap names within the S&P 500, more of them did not advance their price. Another easy way to see this is taking a look at the ETF RSP, equal weighted ETF of the S&P 500. The regular S&P 500 is market capped weight. So when you buy VU or SPY and you're buying the S&P 500, a huge portion of that is going to NVIDIA. A huge portion of that's going to Google. If you buy this, the RSP, the amount of money going to NVIDIA and Google is the same amount as the very smallest companies in the S&P 500. And so when you have that divergence between the advanced decline line and the price of the S&P 500, you can expect the price actually to drop by almost 0.5% on Friday. Me and my crystal ball see the S&P 500 continuing lower in price from here. Oh, calm down, Drakmar. It's going to be okay. It'll go back up eventually. Nike stock NKE came out with not so good guidance. They don't think they're going to sell as many shoes as they've been selling. Whenever something drops enormously in price, like Nike has very recently, it goes onto my radar and I check it out. So I ask, is Nike at a fair price now? Should I buy it? First and foremost, I like to take a look at the PE ratio, especially what the average PE ratio has been over the past 10 years. This normally is supposed to include a recession, by the way, which we haven't exactly had since 2015, which are the past 10 years, meaning that we're not seeing the kind of contraction that we would see in a true economic downturn. So everything I'm going to talk about is based on best case possible scenario. Now, I get the EPS year by year. You can just highlight this. I put it into ChatGPT real quick to get the average. So the 10-year average earnings per share over the past 10 years has been $2.61. Notably, they're all positive. That's a good sign. Again, without a recession happening, which, it can mean we see a negative number in the future. You've been forewarned. Number one. But we need to get through the rest of the information. Times a 25 PE ratio. So when you're looking at the past 10 years of data, a fair price generally for especially a wide moat, big company like this, it would be a 25. And some people say, well, it depends on the industry. Yeah, and, the market also rotates by sector what they think an acceptable PE ratio is. So I stick to the basics. 25 PE ratio average over the past 10 years, I think, is a fair way to do it. Fair, conservative way. That's how I'm going to invest my money. And so that comes to a price of $65.25, notably a little bit lower than the current stock price. So that is what I would consider to be a fair price for this, not a cheap price. So if I was looking to simply invest money in a stock that I think is probably a good company that's going to keep paying out dividends and everything, I'd say, yeah, let's buy it. As a value investor looking for the cheapest thing, maybe I can wait a little bit. I generally like to see a 30% discount to what I consider to be a fair price for something, as Benjamin Graham does. So the other details with this is, yes, it's wide moat, so you can have the normal valuation and have that count. Again, the trailing 12-month PE ratio is 22.6, a little higher. I want to see this at 20, ideally, for just a regular investment. I want to add that this company has an amazing dividend history. This is from Macro Trends, showing the dividend history back from 2005. Where my mouse is right now, the middle chart is the dividends paid out. 9 cents, 10 cents, 20 cents, 40 cents, all the way up to $1.40 in 2024. We haven't seen a drop in dividend payments until very recently, down to 110 in Q3 of 2024 and staying at that level. And the percentage yield has gone up and down as low as, let's see here, 0.7%, and as high, when the price went way down, as high as 2.38%. So on a current percentage basis of its price, it's already cheaper than it's been for a while. So in my book, again, not a terrible stock for investment at this point. However, another piece of this is that, as I mentioned earlier in the show, the whole market is clearly overvalued, with the CAPE ratio and the PE ratio of the entire S&P 500 being at extreme danger zones. The amount that the whole market can drop is a lot, and when the tide goes out, all ships drop. That's one of the dangers of trying to invest in any stocks right now. And, that gives me further caution, and that makes me also, add to my case, besides the fact that this 10-year average earnings does not include a recession or a depression, I need to see at least a 30% discount to the 10-year average earnings in order for me to be interested in this stock, and that would be at a price of $45.68. Last main headline agenda item for today. I am still short gold. I'm long the GDXD. If and when gold gets below $29.50, $2,950, that's when I'll be exiting. I'm going to try a different order of events. Usually I do my charts after community topics and coming up next week, but today I'm going to put it right after the headlines, and we'll do these two items after. Again, the S&P 500, the SPX, still in this bear flag. As I said earlier in the show, we had triple witching, expiry of options contracts, which kept it in here. Still looks very bearish. Advanced decline line showing weakness. This is typically a bearish sign. RSP equal weight dropping in price, while regular S&P 500 rising in price. This is a bearish sign. Add to this the VIX, still not dropping very much. We are under $20. We are still in contango. We're not in backwardation in the VIX futures curve, but it's still close to that 20 mark. Where the VIX stands adds to the bear case more than the bull case at this moment. It looks like we may be forming a little bit of a bottom in the VIX short term. TLT, my favorite place to be. One way of looking at this, very simply, we have a lower high now and a higher low so far. This looks more sideways than anything. However, when you take a look at the upside down version of TLT, TNX, the 10-year Treasury note yield, this pattern is still pretty strong with the bear flag. It still looks very bearish here. Again, on Thursday, we hit that 500-day moving average, bouncing off of it. It looks bearish, which is good for the price of TLT. DXY also fighting that 500-day moving average, interestingly. Continuing more sideways than anything and looking more bullish very recently, but it really could go anywhere from here. And Dr. Copper with a PhD in economics with a double doji at the top of a run. This is a bit foreboding. This can suggest that we have a top here in copper, possibly. This is a very, very tight fight zone, which means there's a big battle between the bears and the bulls here. When it breaks, it will more likely break to the downside than to the upside, but the longer we fight here as well, the bigger the potential break is. Importantly, or unimportantly, the CNN Business Fear and Greed Index still in extreme fear mode. One thing me and my crystal ball sort of foresee is that maybe the beginning of the week, maybe Monday, we shift into that fear zone so that it can continue to get more bearish. Extreme fear tends to mean that the fear has gone a little too far, and then we got to relax it so everybody's comfy again before we can keep going down. The front end of the U.S. Treasury yield curve still inverted. This is saying that the Fed is currently, with their monetary policy, strangling the economy. We were getting into the territory where we were easing, but now it's strangling. We were strangling, right? I brought this chart up recently in a video. I wanted to do a cleaner version of it from FinViz. Remember, for when we take a look at the performance of various sectors, especially the 1 week performance, energy outpacing the entire market by a large margin. Same with the 1 month performance, although negative, less negative than everything else in 1 month. 3 month energy, top performer by far. Half year performance as well, it's within the top 3. Taking a look at a chart from Fidelity that shows the typical sector performance throughout early cycle, mid-cycle, late, and recession, we can see that energy is negative in the early part of a cycle, neutral in the mid, performs very, very well in the late, and then we get negative during the recession, with energy performing in the top 3 in the last 6 months, and the top performer of the past 3 months, 1 month, and 1 week, says to me, once again, we're on the edge of a storm, and we're not in it yet. When energy starts going deeply negative and we start seeing consumer staples and healthcare and utilities outpacing everything else, that's when we know we are in the recession or depression. Next chart that is catching my eye is the 10-year break-even inflation rate, continuing higher after reaching a bottom. I wasn't sure when this was going to bottom. It looks like we've at least bottomed and are going sideways. We'll have to see if this move upward has legs to it to continue higher or not. Again, like I've said on many shows, over the past many years, we've been stuck in this expected inflation range of around 3%, averaging over the next 10 years, all the way as down as 2%. We've been in this range. This is not saying that inflation is going higher. This is the best way to see what the market is pricing and believing inflation will be over the next 10 years. Well, you've seen the news, inflation is coming and it's going to run away. We're going to have terrible inflation. This market that has more money than you can imagine betting on the inflation rate over the next 10 years is saying no. We are going to be, currently we're believing anyway, that we're somewhere between 2 and 3% over the next 10. Last chart of the day, the 10-year minus 3-month, still inverted and going sideways here. Once we start getting more aggressive cuts, this will be spiking to the upside. And when that occurs, that's how you kind of know, like, yeah, it's over. We're in the recession. It's happening, along with unemployment shooting up and all the other crazy things that happen. At least that's what I think. That's what I see in my crystal ball. Community topics. Thank you so much for sharing your largest positions. I found that to be very interesting. I love hearing what you guys are invested in. It's just fun. It's fun for me. It's a game and it's a lot of fun. The community topic I have for today that I'd like you to comment in the section below is, what's the biggest mistake that you've made in investing? When I started studying finance myself in around 2018, 2019, the biggest mistake I made was not recognizing, along with everyone else, right? Not recognizing at the bottom of the COVID dip that, the fiscal policy and the monetary policy was going to indeed turn into a check mark recovery, as some banks had suggested. And that's very clear in retrospect. And, looking at the valuations of things, it's pretty clear that that was a good time to get in. Granted, if I had got in at that point I was buying stocks at that time, just not enough. And that was really my biggest mistake, I'd say. But, Jerome Powell himself, it was in the news, this rally, the first rally that you had from the bottom of the COVID 2020 dip up to the peak of 2021 or 2022 and end of 2021, I think it was. Jerome Powell himself sold loads and loads of stocks about halfway up because, like me, he can understand, like me now anyway, he can understand valuations and when things are getting a little more dangerous. Like, just because you miss out on people basically gambling prices going way higher than they should, doesn't mean that that was a mistake. I don't see, missing the second half of the wave as a mistake, but it was a mistake to miss the first half for sure at this point. So what was your biggest mistake that you've ever made in investing? I'm very curious to hear. And then for next week, the most important data coming out is Thursday. We have quarter 4 GDP, the second revision coming out. If it's revised lower, that can add to the bear case of things, as it often does. As it often happens right before recessions, you get downward revisions. Not the hugest thing. The bigger thing, again, is quarter 1 preliminary data suggests that we are already in a contraction of negative 1.5% contraction in GDP, suggesting that we might actually be in the storm, by the way. We might not actually be on the edge, like I keep saying. And then, of course, for Friday, we have the PCE, the Fed favorite inflation gauge, coming out next Friday. Again, as always, thank you so much for watching. Thank you so much for subscribing. I'm almost at 1,000 subscribers. That's awesome. And thank you for all of the support. That has been incredible, how much support I've been getting directly from the community. So that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.